Hey, hello investors and future investors. Welcome to the channel. For today's video, we're going to be doing live trading. I'm going to be showing you a stock and I'm going to be giving you an exact walkthrough of the strategies that I will be doing. And most importantly, I'm going to show you how to use this stock, these strategies, and how you could use them to make money in the long term and also the short term. Now, if this sounds like something that you can relate to, then in that case, welcome to Investment Gains. Let's jump right into it. Welcome back investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, we're going to be doing live trade Wednesdays. I will be giving you a complete walkthrough of the option strategies I will be using in order for you to be able to follow along with me. And not only that, if you so choose to, maybe you could go ahead and practice these option strategies in your portfolio. Now, you guys know how we do it. We like to go ahead and get down and dirty with options. The stock for today is going to be none other than Kenvue, and that ticker is KVUE. Now, for those of you not familiar with this stock is Kenvue, and it used to be a subsidiary of Johnson & Johnson, which is a monster company. Now, I will go ahead and do a complete detailed video about Kenvue, probably for my Friday video or my Monday video, but I don't want to get into too much details today because the whole purpose of today's video is to show you live trades, how I'm going to use this stock to make money. Now, for Kenvue, the first thing we're going to do, we're going to go ahead and jump into the advanced feature here in order for us to go over the chart. We're going to go to the 1 year outlook in order to see how this stock is performing. Now, as you can see here, this blue line right here, which represents the 200-day moving average, that tells us that the stock over the last 6 months or 200 days has been trading around the $21 mark, the 21-ish mark. Now, the 200-day moving average is at the $21 mark. However, the current share price of $17.20 to your top left here, that is way below the 200-day moving average. So immediately that tells me that there's a lot of opportunity for the stock to go up. Can the stock continue going down? Absolutely. But what I see is that there's more upside than there is downside. Now, we're going to go ahead and we're going to go down to the RSI right below that. And I have my RSI 50 right here. So the RSI tells us that the stock right now is trading at around a 40 RSI. Now, a 40 RSI in my books, according to my risk tolerance, is exceptionally good. Just for analysis, the RSI measures from 70 to 30, with 50 being the middle point. So any stock that has an RSI of 50 moving towards the 30 mark tells you that that stock is going to oversold territory. So now that we have an RSI of 40, the current share price of 17, and also the 200-day moving average of $21, I want you guys to remember these things. Now, what we're going to do, we're going to go ahead and look for a strong level of support. You could only find a support level below the current share price. So for that, we have to go all the way down. Now, as you can see here, there is zero support on this stock. So once again, this stock could continue going back down. Now, the reason why I decided to use this stock and add it to my portfolio, I'm going to go ahead and show that to you right now. So let's go ahead. We're going to go back to the stock. Now we're just going to jump into some of the basics. So this stock, like I said, is a subsidiary of Johnson & Johnson's. They actually broke away and formed this new company. So it's completely independent from Johnson & Johnson. The main reason I decided to add this stock to my portfolio is based on the brands that it's offering. Aveeno, Band-Aid, Johnson's, Listerine. Most of these brands has been around even before some of us were born. So I don't see these demand in these stocks going to be reducing anytime soon. So that's my strong why I'm getting into this stock. Now, the stock, although it's trading at around $17 right here, the 52-week low is at $16.89. So the 52-week low is really close to the current share price. So again, the 52-week high is $25. So the current share price is way closer to the 52-week low, so that gives us way more upside again than there is downside. Now we're going to go ahead and we're going to scroll down a bit more, so I'm going to give you a bit more information. Now, under the trading trends, which I really like to monitor, if you look at Robinhood retail traders, you could see these guys have been buying this for almost the entire year, for Q1 and Q2. If we go over to the hedge funds now, you could see the hedge funds as well. They have been eating this up. They actually start getting into the stock in Q4 of 2024, and they've been buying and they keep increasing their buys right here. So that helps me come to even better, stronger decision based on my thesis. Now, if you go down here to the analyst ratings, which is very strange to me, the overall consensus is that this is a hold. In my books, I think this is a very strong buy, but the analysts said it's a hold. Now, the rating for this stock, it does have a 5-star rating, and the actual fair value, what Wall Street put on this stock, is $24.50. So this is the third scenario where you could see there's a lot more upside than downside because they think this stock should be worth $24.50. Now, let's go ahead and get into the strategies I will be using with this stock. Now, the first strategy I'm going to be using with this stock is that I'm going to go ahead and buy this stock outright. I think this stock is trading at a very fair price, and I'm going to go ahead and get the shares. Now, once again, the shares price can continue to go down, but it's a chance I'm willing to take based on my own due diligence. Speaking of due diligence, you guys need to do yourself 2 favors, which is going to be always make sure to do your own due diligence before investing. What may work for my portfolio may not work for yours. The second favor you're going to do yourself, always make sure to have an exit strategy before entering any options trade. And we're going to be getting into options trade just now. The reason why you want to do that is that in case the trade goes against you, then at least you know how to get out of the trade. So the first strategy I'm going to do, I'm going to go ahead and I'm going to buy the shares. Now, there's 2 ways to buy the shares. You could go ahead and pick up 100 shares right now based on the size of your portfolio, or you could do the best option strategy, which is going to be DCA, or dollar cost average, wherein you go ahead and you buy a fixed amount on interval basis. So you're going to buy $20 every single week continuously, and that's going to grow your portfolio with Kenvue. Now, the second strategy I'm going to go ahead and use for that, let's go ahead to trade KVUE options down here in the bottom in order for us to go ahead and open up the options chain. So those of you that have been getting value so far, now would be the best opportunity for you to go ahead and like the video, and also remember to subscribe to the channel. Now, this here is the options chain, all this information down here. What the option chain does is that it gives us enough information in order for us to make a very informed decision before entering any options contract. So the next option strategy I will be using on Kenvue, I'm going to go to buy, I'm going to go to call, and then now let's go ahead and choose our strike date. The strike date I'll be going with is going to be January 21st, 2028, and that's going to give me 849 days to expiration. The reason why I decided to go all that way out, which is going to be about 2.5 years, is because what I want to do is buy myself enough time in order for this trade to go in my favor, in order for me to be right based on my thesis. So with your buy, with your call, and your long dated expiration date of more than 2 years out, now we're going to go ahead and we're going to choose the strike price. Now, the strike price I will be going with is going to be the $13 strike price. Now, the reason I'm going with the $13 strike price, I will show you in a minute. But here's one very important thing about the $13 strike price. As you recall, the 200-day moving average was at the $21 mark. So that should be right around here. The current price I'm choosing is going to be below the 200-day moving average. The next price point was the fair value that Wall Street gave this stock. Wall Street think this stock is worth around $24.50 or $25. So that would be up here. I've decided to go below the fair value, go below the 21-day moving average, and thirdly, below the current share price in order for me to give myself enough wiggle room in case this share price decides to go down again. This share price here is what's going to be known as deep in the money, way below the share price. Now, the other reason I'm going to be going with the $13 strike price is the delta that I'm given. You can see delta to the top here. The delta I'm going to be given is going to be 0.90, or I have a 90% delta. And most importantly, the reason for me to choose the $13 strike price is the amount of money I'm going to have to pay. The amount of money I'm going to have to pay is going to be $5.65, which in the real world is going to be work out to be $565 because each option contract does contain 100 shares. So you simply multiply your $5.65 by 100 and you should get $565. The reason why the price point is really important to me is because I bought myself 2.5 years and I'm only paying around $565. So I think that's a really, really good price. Let's go ahead and select that. This option strategy that I'm going to get into with Kenvue or KVUE is going to be a LEAPS option. LEAPS stands for Long-Term Equity Anticipation Securities. What LEAPS are, essentially, they are long calls. However, a LEAPS is a long call that extends 365 days or beyond. Now, just going back to the strike price. You could go ahead and choose a strike price of 15. You could choose a strike price of 10. I think all these strike prices are good. I even think the 17 strike price is good because it's below the fair value. It's also below the 200-day moving average. So I think that's fine as well. I just decided to go ahead and choose this one because this one suits my portfolio risk. Now, before I go ahead and show you another option strategy I'm going to use, I want to bring one thing to your attention. With the $10 strike price here, you have what's known as a perfect delta. A perfect delta is always going to be 1. So you have a perfect delta here of 1. That means if the share price here goes up by $1, then your options is going to go up by $1 as well. Now, just to show you the comparison, the strike price that I chose of $13, if the share price goes up by $1, then my option is only going to go up by 90 cents. So by choosing a $10 strike price, you have an exact one-to-one. You have an option that mimics the exact share movement, which is called the perfect delta. You hardly ever see this. Now, with the LEAPS option strategy, this is a bullish option strategy. So what you need to do, you get this and you put it in your portfolio, and all you're doing, you just sit on it and just waiting until the share price appreciates. Once the share price appreciates, then I'm going to be making an ROI or return on my investment. Now, this is the best option strategy that I use. This is like my bread and butter option strategy because I like it. I do not have to monitor the market and I just have to be patient with it. Now, for those of you that have twiddle fingers and just cannot stay without doing anything, I'm going to show you how to use this LEAPS option with another option strategy in order for it to go ahead and make consistent income. Now that I have the LEAPS in my portfolio, and remember, my first strategy was to buy the shares outright. So I'm going to show you how to use that as well to make consistent income. Now, we're going to start off by using the LEAPS option to make consistent income. And for that, now we're going to go ahead, we're going to go to sell. We're going to go to call, and then now we're going to change the strike date. The strike date I'll be going with is going to be October 31st, which gives me 37 days to expiration. Ideally, what I am looking for, because I have such a long expiration date on my LEAPS option, I'm looking for a 45 DTE or 45 days to expiration. However, that's not available, and the closest one is going to be the 37 days. So I'm going to go ahead and select that. Now, the strike price I'm going to be choosing is going to be above my current share price for this case, because this new option strategy is going to be known as the covered call option strategy. Now, this covered call option strategy, we're going to be doing it using our LEAPS option as collateral. So that creates a new option strategy known as the PMCC or the poor man's covered call. If you need a detailed video of how to use the PMCC and how to make consistent income with it, go ahead and search the channel for PMCC. Now, the strike price I'll be going with is going to be the $19 strike price. Now, that strike price is not random. If you were to go back to the LEAPS option, then you would see under your break even, you would see the break even on that was around $18.50, or I think it was exactly 18.48. So let's round it up to 18.50. So you're going to need to review the video to go ahead and see that. What the break even tells you is that at expiration date, more than 2 years from now, if this share price is trading at $8.50, then you would not lose any money. Meaning the $565 that you paid for this LEAPS option, you're going to get your money back in full. You have not lost any money on it. Now, I'm a bit more conservative. So what I'll be doing, I'll be going with the $19 price right here. And I'm going to accept a lot less money, which is going to be $28. $28 is going to be perfectly fine for me. Now, what I really like to check is my ROI or my return on income. So because I'm doing this cover call using my LEAPS option as a collateral, I'm going to have to check my ROI. My ROI is going to be the amount of money I'm going to be receiving for this option strategy, which is going to be $28. And I'm going to divide that by my collateral, which was $565. So 28 divided by 565, that's going to give me a ROI or return on my investment of 5%. 5% is extremely good on a monthly basis. Now, here's the exit strategy. Because I have a 37 days expiration, I'm looking to get out of this covered call, only the covered call, not the leaps option. I'm looking to get out of this covered call whenever I'm up around 50% of the trade. Or let's say I'm up like $17, I'm going to get out of the trade. And then that's it. I'm going to go ahead and sell another covered call for the following month. And that's how I'm going to make consistent income with this stock. Now, this is what you're going to do once you go ahead and close it off the first time. It's quite simple. You're going to do three things. You're going to rinse, you're going to repeat, and you're going to keep locking in your investment gains. That's how you're going to grow your account portfolio. Now, what we're going to do now, we're going to go ahead and sell covered calls. Now, the covered calls we're going to be selling is going to be based against the shares that we picked up. Remember, this one is going to be based against the leaps option. So we're going to be doing that based against the shares. Now, since you're going to own the shares outright, you have a lot less risk because you own the shares. So what we're going to be doing, we're going to be changing our strike date. Let's go with October 24th, which gives us 30 days. Because you own the shares, you could choose a way closer expiration date because the risk is a lot less when you own the shares as opposed to when you own the leaps option. So now I'm going to go ahead, I'm going to choose my strike price. Now, the strike price I'll be choosing is going to be $18.50 right here. Now, once again, because I'm doing this covered call based on my shares, I could take a bit more risk. So I'm going to be going with the 18.5, which is going to be directly at break even. The break even is not really going to matter much for this strategy because this is the shares that you own outright and not the leaps option. So what you're going to be looking for is your average cost. Your average cost, if you decide to pick up 100 shares today, is going to be $17.16. So all you need to do is sell a covered call above this and you should be good. Hence, I'll be going with the 18.5. The 18.5 is going to pay me 0.27 or $27. Once again, each option contract does contain 100 shares. So you multiply your 0.27 by 100 shares, and that's going to give you $27. Now, what we're going to do, we're going to look for our ROI. Now, our ROI is going to be a lot different because now, once again, we're going to be using the shares as collateral. So we're going to divide our income we're going to be receiving, which is going to be $27, and we're going to divide that by the current share price, because if we buy 100 shares today, this is what we're going to be paying. So we're going to divide that by 1717, and that should give us an ROI of 1.5. Now, hopefully you guys see the difference. Your ROI is going to be way higher doing the PMCC option strategy or using your leaps option as opposed to using your shares. So use that information however you want in order to go ahead and do either of these option strategy, whichever one benefits your portfolio the most. Now, this is it right here. This is the second option strategy that I would be going ahead and do. Now, one of the reasons also I would want to own the shares, which I probably overlooked, is that this company pays a very good dividend. They pay a dividend of above 4%. So you would be able to, if you go ahead and choose the shares route, you'll be making money on your covered call, consistent money. You're going to be making money with your consistent quarterly dividends of 4%. And you're also going to be making money on your share price appreciation, which means whenever the price goes up from here, whatever it is, then you're going to be making money that way. So you stand to make money three ways if you own the shares. Hopefully this video was not too long, and hopefully you guys got lots of information from this video. I will go ahead and make a detailed video about Kenvue to show you all the other aspects of this, the risk, the reward, and everything else. However, this is exactly what I'm going to be doing. I was not able to close off some options, so I cannot go ahead and execute this trade live, which is sad. What I will do, however, our next Wednesday live trading video, I'm going to go ahead and show you these options in my portfolio and where I'm at that point in time. Now, that's it, investors and future investors. This is the exact option strategies, the exact options trades I will be using on Kenvue, which is KVUE. These are the exact strategies also I'm going to be using to make consistent income with this stock. I will go ahead and give you a follow-up on next week's Wednesday. So if you haven't already, now is a good time to go ahead and subscribe to the channel. If you guys have any questions about any option strategy that we did here today, or any questions of KVUE, then go ahead and let me know in the comments below. Now, the most important thing is that I do create all this free content in order for me to help people out there. If you guys know anyone struggling to grow a small account portfolio and you think this content could actually help them out, then the right thing to do is to go ahead and share this video with them. Let's try to help as many as we can. Now, until the next video, keep pushing your investments.